Hi, everybody. We're back for another semester talking about finance and all the interesting things that finance theory can tell us about things that are happening in the world today. I'm Josh Spizman. I'm professor of finance at Loyola Marymount University in Los Angeles. And as usual, I'm joined by my colleague, David Offenberg. And David, I've been seeing the news and I keep reading about mortgage rates have just been going up, up, and up. They're now over 6% in some cases. And was hoping you could explain to us why that's interesting and why should we care about what's happening in the mortgage market.
Yeah, I'd love to. And we can start by doing some basic time value of money, just like we're doing in class. So for today, I'm going to use a 30-year mortgage on a $500,000 house. And we're going to look at it two different ways. We're going to look at a case where the borrower is paying 2.75% interest. That's what you might have paid back in the depths of the pandemic, and another case where a borrower is paying 6.25% interest. That's what the going rate was in the past week. And so what I've done here is I've shown the amount of annual payments that those two borrowers would pay. So on the 2.75%, it's about $25,000 a year. On the 6.25%, it's closer to $37,000 per year. Now, let me layer on top of that the interest that these borrowers will have to pay. And this is where it starts to get interesting, because the blue dots here are the interest on the 2.75% loan. The yellow dots are the interest on the 6.25% loan. And so that borrower paying 2.75% is paying less than $14,000 a year in interest. Whereas the borrower at 6.25, they're paying over $30,000, more than twice as much. And you would expect it to be more than twice as much, right? Because the interest rate is more than twice as much. But check out, again, this orange line showing the annual payments for the borrower at 2.75%. It's actually lower than what this person is paying in interest. They're paying so much in interest that they're paying more than this borrower is paying just in total payments. And for as long as they go, all the way out to 30 years, they're going to continue at 6.25%, paying more interest than the borrower at 2.75%. And now, to make it more interesting, let me layer on the principal. And so the orange dots are the principal of the borrower at 2.75%. So what that means is that this very first orange dot in year one plus this blue dot equals the orange line. And that's true all the way across. The blue dot plus the orange dot equals the orange line all the way over to here. And similarly, the green dot plus the yellow dot equals the green line all the way across. And what you can see is that even though the borrower at 2.75% is paying a smaller payment, they're paying back more of their loan each month. And they're going to continue paying back more of their loan each month until the 19th year. For 19 years, they get to pay back more of their loan. Now, it has to flip at some point. It has to flip because the borrower at 6.25 still has to pay off a whole $500,000. So they have to pay off the whole thing at some point, and they have to pay more principal at some point. But it doesn't happen until the 19th year. And so what that means is that this borrower at 2.75% is paying smaller payments, they're paying less interest, and they're building more equity in their home. And with that equity, they can get a home equity loan. They can continue to improve their home. They can get other loans for cars or college or whatever else. They have much more money to spend. They have more disposable income, and they have more wealth. The borrower at 6.25% is accumulating wealth way more slowly, and they're really going to have way less disposable income. And so there must be then for economy-wide good implications of all this, right, Josh?
Yeah, I mean, I love your example because it's so obvious. Each year, the higher interest rate person has to pay about $10,000 more per year in total, and that has huge implications. Just think about anyone out there. Think about yourself. If you had to pay $10,000 more per year to live in the same house that today than you would have just last year, that's going to mean much less housing activity, right? There's going to be less people who are able to be buying houses at the current prices. It's also going to mean people are less willing to sell their prices. Those of us that have that 2.75% mortgage rate are not going to want to so quickly sell our house and now lock in a 6.25% mortgage rate. So I think, that's one of the really nice implications of all this is you're going to see that less housing activity overall. And then, of course, with that less activity, so both lower, potentially lower supply, but also much lower demand, that should kind of bring a home price decline as well. And this is all really fascinating stuff. And your examples just hits the nail on the head because it's so clear with such a simple example.
And so what we saw this week then is that the Fed is actually raising rates. They're going to make these rates even higher, make these payments even higher. And is why is that going to happen?
Yeah, so that's a great question because we're sort of talking about doomsday here. It's like all this seems so negative. But what the Fed is trying to do, and people who are following the financial news, know this is we're really working on inflation and worried about inflation. And I think, this example here really shows you what's happening with home prices. You can kind of see how the home prices have just gone up. They've increased over time, sort of, minus the housing crisis in 06 to 08 area, where there was a decline, but it's really been going up, for the last 10 years or so, the home prices. And this is a concern is as home prices keep rising, it becomes more expensive for people to get into a home. So there's going to be less activity, and so what the Fed is trying to do is raise rates to essentially slow down the price increase of the housing market.
And we'll see if it happens right, the way that they're predicting, right?
Only time will tell.